Welcome to the 3 Steps to Startup Masterclass series, brought to you by Tech Connect West Virginia, Innova Commercialization Group, and the West Virginia Jobs Investment Trust. This masterclass series is part of the 3 Steps to Startup initiative. The goal of 3 Steps is to provide early-stage entrepreneurs with critical assistance and structured guidance for innovation commercialization, from ideation to product launch and market entry. 3 Steps to Startup is made possible by support from the Appalachian Regional Commission and the Claude Worthington Benedum Foundation. This is Masterclass number 4, Startup Funding Over Time and Across the Continuum. Today's Masterclass is one in a series, in which viewers will have an opportunity to gain deep insights and actionable intelligence designed to help entrepreneurs launch and grow their ventures. Within each masterclass, we will take a deep dive into a specific topic to teach the what, how, and why so that you, the viewer, may be better informed and duly prepared to apply your newfound wisdom in a manner that will positively impact your new or early-stage venture. Here's a preview of the concepts we will be covering in this masterclass, each of which is designed to help you connect dots, grow professionally, and become a more efficient and effective entrepreneur. This masterclass is all about understanding the types of startup funding available over the life of the startup and across the continuum of capital. We will begin by examining the myth that there is a scarcity of capital available to startups. We will dig into the various types of corporate structure and discuss which may be preferred by investors and why. We will walk through the continuum of capital and how to determine funding milestones over the life of the startup. We will explore the 3 main types of crowdfunding and how each one applies to startups. Next, we will cover how best to prepare for the funding process and the most common deal structures and terms. Finally, we will provide a 10-step pitch structure, enter the mind of the investor to learn what they want and need, and offer some simple guidance on closing the deal once an offer is on the table. We will end this masterclass by posing several questions for reflection as you marinate on all we've shared with you today, and by sharing additional resources you might choose to leverage for your own extended learning. We have a lot to cover, so let's get started. For far too long, there's been an enduring myth that's given entrepreneurs and would-be entrepreneurs the wrong idea about the availability of funding to fuel the growth of their ventures. The myth tells us that startup and early-stage capital is only available for high-tech, high-growth ventures. Further, the myth tells us that funding may only be found in areas like the Silicon Valley, Chicago, New York, or Boston, whereas roughly 75% of venture capital dollars have historically come from the VC holy trinity of California, New York, and Massachusetts. This statistic doesn't tell the whole story. First of all, venture capital is only one of many options for most startups. The television show Shark Tank has popularized venture capital and has dramatized the deal-making process. However, venture capital funding isn't the only game in town, or the only reasonable option for entrepreneurs. Bootstrapping, bank loans, friends and family, crowdfunding, micro-venture funds, and angel investors all represent potentially viable options for startups and early-stage ventures needing to fund the next leg of their journey. Second, we must consider that perhaps the size of the funding asks in areas outside of Appalachia or the Midwest might be greater due to the nature of the business, inflated valuations, greed, or a host of other reasons. Investors are becoming increasingly cognizant of a gap in the investment market, and as such, more investors are turning their eyes towards historically underserved areas, such as Appalachia and the American heartland. In short, VCs from California, New York, or Massachusetts aren't the only option, and you don't have to be proposing the next Facebook or Amazon to get the attention of potential funders. In fact, many investors across Appalachia prefer that you have something else in mind entirely. So, if the scarcity of capital myth is false, and there are indeed funders seeking investable deals of all sorts across Appalachia and beyond, how might an entrepreneur get the funds they need? Well, the answer to this question has a few layers to it. We learned in the classic Kevin Costner movie Field of Dreams that if you build it, they will come. Though the movie had an entirely different it and they in mind, the premise still holds true in this instance. Investors will have their fortunes eroded by inflation if they don't find good deals in which to invest. They are actively combing through local higher education institutions, pitch competitions, incubators, and accelerators, trying to find great new opportunities. They are working their contacts and expanding their network in order to increase their capacity to see what new venture they can fund. If you as the entrepreneur build it, and by it we mean a new venture worth finding, they, the investors, will come and find you. It's their job to find you. Their livelihood and future as investors depend on them finding you. So, as you see, if you build it, they will come. But the question remains, how does one build a venture that is attractive to potential funders? An entrepreneurial venture doesn't begin to move from the realm of ideas into reality until the underlying business entity is formed. Selecting the type of legal business structure for the new venture is just one of the many critical decisions an entrepreneur will be forced to navigate. There are pros and cons for each entity type depending on the venture's current situation and its designs for the future. The type of business entity selected will determine a range of ramifications related to such things as legal liability, internal management, taxes and accounting, and external funding eligibility. For example, with a sole proprietorship, there are no protections in place to shelter the personal assets of the entrepreneur from any claims should a liability befall the business due to, for example, the negligence or fraud of an owner or employee. Meanwhile, a limited liability corporation, or LLC, is designed with this exact purpose in mind: to insulate the business owner's personal assets in the event that the business was to find itself on the wrong end of a lawsuit. However, there is much more to being considered investable than legal protections. Though it may be possible to change from one business entity type to another, the best and cleanest option is to choose wisely in the business formation stage. Certain types of business structures are non-starters for external investment, while other structures will be more attractive. Generally speaking, professional investors do not favor what are called pass-through entities, also known as flow-through entities. These are business structures wherein business income passes or flows through the business entity to its owners. Each owner is fully liable for all obligations, debts, and liabilities incurred by the entity. The entity acts as a flow-through, wherein profits and losses flow through to the partners in accordance with their ownership stake. From a tax perspective, business income is treated as the owner's personal income, and the tax liability flows to the business owners, leaving the business income subject only to individual income taxation. This treatment of income effectively makes the entity exempt from corporate income tax, allowing the owners to avoid double taxation. Though this arrangement may be favorable for the business owners from a tax perspective, professional investors are not fans of pass-through entities, such as sole proprietorships, partnerships, LLCs, and S corporations. Because of frequent delays with tax filings, and due to early losses being passed through to the business owners. In equity investment deals, investors are accepting an ownership stake in the company through the provision of equity in exchange for their investment. Therefore, as these early losses are passed through to the business owners, the investors will now be included in this pass-through event. Though the consequences of the loss pass-through can be overcome, it creates a minor complication the investors would prefer to avoid altogether. That said, other types of deals may be an option, such as debt or revenue share investment, and these types of deals can be effectively and efficiently structured through an LLC. When an equity deal takes place, the original business owner will begin to experience shared ownership of the business with the new investors. In these situations, equity generally denotes the ownership interest as represented by shares of stock. The investor's equity shares may hypothetically take the form of either common stock or preferred stock, though angel and venture capital investors will almost always desire to purchase preferred equity shares, mainly to ensure their investment has preference over common equity shares in a liquidation event. Sole proprietorships and S corporations are not suitable for professional investors because of their limitation in offering different share classes. In general, investors prefer the C corporation structure because it addresses all the issues listed above. And so initially forming as a C Corp will keep the entity from having to convert from another structure prior to raising funds. Now that the myth that there is a lack of available capital for startups has been dispelled, the next point of consideration must be concerned with how to access this pool of money. Well, to begin with, there is no single pool of dollars available to help fuel startups and early-stage ventures. In fact, there are numerous options available to firms seeking an injection of capital depending on the nature of the business, their stage of development, current financial position, immediate and near-term needs, and plans for the growth and development of the business venture. The question isn't whether there is funding available, it's more so what pool of money may be the best fit for the venture. In Masterclass number 3, we talked about the notion that not every customer is a good customer. There must be a mutual benefit and a proper fit for both parties. The same belief holds true here as well. Just because someone is willing to offer you funding, that doesn't mean you should accept it. Just because it seems to you that a certain funding source is a good fit for you, that doesn't mean that the funder will see things similarly. In general, an idea-stage startup that hasn't yet formed a business entity, let alone proven early traction or proof of concept, will not likely have success attracting venture capital dollars with an ask for several $1,000,000. An established high-growth firm seeking an investment to scale their operations will not likely seek funding from friends and family. A young entrepreneur with no track record, little credit, and few liquid assets will not likely have much success in securing a bank loan that typically requires strong credit and meaningful collateral. Funding is a match game where both sides of the equation, the funder and the entrepreneur, need to agree that moving forward in the funding deal makes great sense. Let's examine the graphic above. The flat green line moves from left to right and represents time, or the age of the venture. The looping blue line stands for the venture's cash flow, dipping in the early going before beginning to take off later. Along the bottom are 3 stages of venture development, from idea or startup stage to the development stage to finally the growth stage. Just above these stages are 10 sequential boxes containing the names of a type of funding and a reasonable representation of an average amount of funding that may be sourced there. Plotted along the green timeline are 5 milestones the venture will hope to reach over time. With this understanding of how the graphic is laid out and what it depicts, one can review the information contained therein and begin to better understand the many funding options available, when in the life of the venture is the right time to pursue them, and how much an entrepreneur might reasonably expect to receive in a successful funding request. Keep in mind that there are exceptions to every rule, and this graphic is not meant to portray absolutes. Raising capital should not be viewed by entrepreneurs as a one-shot deal, wherein the entrepreneur should try and raise all the capital they will ever need in one fell swoop. This isn't realistic in the least. A good entrepreneur will understand the various stages of development their venture will hopefully grow through. These growth milestones represent significant moments in the life of the venture. Taking a product to market, reaching a designated sales milestone, or expansion to a new geographic market are examples of significant milestones that may require an injection of capital. The goal of the entrepreneur should be to seek the requisite capital to fuel the venture's growth into the next significant milestone, as mapped out within their business plan. The goal should not be to try and gather up and squirrel away all the funds the venture will need across the entire growth journey. This is not a realistic goal, and the concept will not be met favorably by professional investors. Rather than hunting for the mythical white whale that will bestow upon you all the capital you will ever need, you should instead consider the journey from the perspective of taking a cross-country trip. Along the way, there will be wondrous places to see and experience that will represent significant milestones as you make progress in your trip. Your vehicle will need enough fuel to get you from milestone to milestone, and there will be refueling options along the way where you may stop and fill your tank. Your vehicle is your entrepreneurial venture. The journey represents the maturation of your venture from startup through development and growth. Capital will be the fuel for your venture to move from milestone to milestone, and the continuum of capital as suggested in the graphic on the screen represents the various fueling options along the journey. Have the entire journey in mind, but focus on getting safely from milestone to milestone. On the prior slide, we displayed and discussed some of the more traditional means of acquiring startup funding. That list is non-exhaustive, however, as there are other less traditional options available in certain circumstances. For example, you may be familiar with the concept of crowdfunding, though not likely in the context of venture funding. In 2016, a guy named Zach created a campaign on the crowdfunding platform Kickstarter so that he could raise money to make his first batch of potato salad. Sounds like a joke, right? Well, not so much. Zach's campaign was wildly successful to the tune of over 6,900 individual contributors for a total of over $55,000 raised. That's a lot of potato salad. In the end, Zach made his potato salad and had enough to feed a bunch of hungry people. As great a story as this is, however, no new businesses were formed, no new jobs were created, and no local economies were stimulated. Though extreme, this is an example of product crowdfunding where people seek to fund products or projects using platforms like Kickstarter or Indiegogo. Individual contributors pay in advance for the new good or service or to support an interesting project, like making potato salad. There is a different flavor of crowdfunding that applies to entrepreneurial ventures. Equity crowdfunding provides the opportunity to purchase an equity ownership stake in a company. There are many rules and regulations that govern this type of activity, and the Securities and Exchange Commission, or SEC, keeps a close eye on equity crowdfunding to ensure that activities remain compliant with applicable laws and regulations. This is a relatively new and ever-evolving funding option that violated SEC rules until the Jobs Act came along in 2012. Equity crowdfunding is a multi-billion-dollar marketplace that began in practice in 2013, and which is still quite small relative to more traditional means of venture funding like angel funds and venture capital investing. Many founders worry about giving away too much equity or control of their company, especially in earlier funding rounds. Equity-based crowdfunding can result in an unbalanced return where the founder gives up a disproportionate amount of equity in exchange for the capital they receive. That said, crowdfunding may be accomplished via another route rather than the exchange of equity or shares for capital. Rewards-based crowdfunding offers the opportunity for the startup to fund their projects and business activities by exchanging cash from supporters for access to discounts on future company products or services, samples and promotional items, or various other perks or rewards that do not include equity in the company. This type of crowdfunding may be a good option for some startups depending on their particular situation. As with all types of funding, the entrepreneur should consider what funding option might be the best fit for getting to the next milestone. Take the time to learn the ins and outs of crowdfunding before jumping into a campaign or leverage your network to find an expert in the field, as there are many challenges, potential pitfalls, and nuances that can derail even the best-laid plans and cause long-lasting and potentially permanent harm to a fledgling venture. Crowdfunding of any kind requires a great investment of time and effort to craft a compelling marketing campaign to convert curious people into avid supporters willing to financially support the venture. Early campaign traction with quick funding commitments is indicative of successful campaigns. The campaign must include a differentiated messaging platform to deliver the right types and amounts of information to the audience. Effective storytelling is crucial to engage the audience and aid in the spread of the message across social networks. As a campaign gains exposure, crowdfunding may introduce the venture to a large pool of potential investors. However, this exposure can be a double-edged sword if the campaign is poorly designed, poorly executed, and fails to produce the desired results. Remember, you only have one chance to make a first impression, so make it a good one if you are considering crowdfunding as an option. Proper prior planning prevents poor performance. This motto absolutely applies to preparing for funding in general, and more specifically, for preparing for the due diligence process when seeking outside investment. A huge part of preparing for the due diligence process is for the entrepreneur to gain a basic understanding of what this process looks like and how it works. Entrepreneurs need to understand that professional investors are not lacking for entrepreneurs seeking to strike a deal and get funded. Investors are lacking high-quality applications for review. Due to the wave of applicants, due diligence begins with a first-blush attempt to deselect an application and whittle down the pile. Time is money, and investors don't want to waste their time deliberating over incomplete or poorly fitting deals. Entrepreneurs must understand that investors seek to make efficient decisions about the fit of a potential deal with their investment criteria, and that the entrepreneur should expect a relatively quick decision about whether their application for funding will be moving along in the diligence process. Entrepreneurs should also be alert to situations where quick decision is not forthcoming and ongoing requests for additional details and information continues to string along the entrepreneur for no good reason. Entrepreneurs must understand that their first goal in the diligence process is to move from the huge pile to the short stack of deals for further consideration. Entrepreneurs must endeavor to learn all they can about the investors to understand who they are and what types of deals they will likely fund. And the entrepreneur should ask the investor what they want to see in the materials to be provided for investor review. Beware filling pages with fluffy visions that cannot be substantiated, or excruciating details about the day-to-day grind. Instead, the entrepreneur should consider what the investor will need to see and hear in order to make an informed decision about whether to invest their money. Storytelling is fine, and sharing the strategic vision is great, but be sure that narratives and numbers are consistent and not telling different tales. Inconsistency between narratives and numbers can be a deal killer. For those entrepreneurs selected for the short stack, the journey will continue. This is where the deeper dive will begin, and so the entrepreneur must be ready to provide additional documentation and make themselves available for formal pitching and follow-on discussions to dig into details about the venture and the entrepreneur. Professional investors may decide to leverage the expertise of an external agent who will lead the diligence process. The external agent allows the investors to maintain a clear perspective and operate on data and unbiased insights. The entrepreneur must understand that this deeper dive will uncover who they are as humans and as entrepreneurs based on past entrepreneurial performance, criminal background, social media profiles, and work history. Professional investors must know all they can about the entrepreneurial venture and the human beings with whom they are potentially making a deal, so they can determine if there will be a proper fit for all concerned parties. Before initiating the process of applying for capital, an entrepreneur should become educated about the various deal structures and common terms in venture funding. Books such as Venture Deals by Brad Feld and Jason Mendelsohn, blogs such as Venture Hacks, and websites such as Seraph Compass are chock full of amazing resources and deep insights that will help to properly prepare an entrepreneur to seek outside funding by raising capital. With a wide range and ready availability of free and low-cost resources on the subject, there is no excuse for entrepreneurs to be ill-informed about deal structure and common terminology related to deal structure. An entrepreneur should not begin the funding process unless they understand the basic structure, terms, and vocabulary of a negotiation and venture deal with professional investors. An entrepreneur's ignorance could usher in the demise of their venture as they know it if they aren't careful and well-informed. There are many different types of venture funding deals out there, with a variety of terms and structures. Most entrepreneurs will think of Shark Tank-style deals, where capital is exchanged for equity in the company. Though this may be a viable option, keep in mind that equity implies an intent to sell the business at some future point so that shareholders can cash in on their investments. Equity should only be sold if there is a plan or desire to sell the company. Deals containing convertible debt or a simple agreement for future equity, or SAFE, are simply future claims against equity, which presents the same issue as noted with traditional equity deals, wherein an intent to sell the business has been implied. Again, if a future sale is not in the plans, these funding instruments should not be used. Debt financing, such as a bank loan, will require a recurring payment to service the loan, whether the venture is profitable or not. and so this type of option should only be considered if current and projected cash flows will support timely payments. Revenue sharing is another funding option that offers flexibility at a high cost, as the rev share agreement provides cash in exchange for future payments based on revenue and not profit. For ventures with steady or accelerated growth and predictable minimum cash flows, this could be a suitable option when used in small amounts to fund the solution of a specific business problem, such as small capacity improvements or new sales assets. Regardless of the type of venture deal, an entrepreneur must seek the right option for the right amount with the right investor at the right time. Never force a square peg into a round hole. Pitching for capital is an art form that portrays an entrepreneur's struggle to convince a suitable investor to fund their venture by virtue of maintaining the delicate, timely balance between providing hard facts and emotional tugs. Too many pitches are off-kilter, providing an excess of factual ammunition too soon in the pitch, plucking too many unsubstantiated heartstring pulls, or a mix of both. Entrepreneurs have the misplaced notion that venture deals are nothing more than intellectual arguments with stoic capitalists, when in fact, though a modicum of detail is surely needed, funding decisions are mostly emotional. There is neuroscientific evidence indicating that the rational center of the brain, the neocortex, is only accessible through its emotional gatekeeper, the limbic brain. Author and speaker Simon Sinek has catalyzed this concept with his golden circle paradigm that captures the need to start with why when attempting to provoke action from others. However, an entrepreneur's why and an investor's why can be quite different. Pitching is a sales activity, and an entrepreneur would do well to always remember this. A basic element of a successful sales presentation is that the salesperson, in this case the entrepreneur, must illustrate very clearly why the buyer, in this case the investor, should care enough to take their valuable time to listen. In short, so what? What's in it for the investor? Why is it in the best interest of the investor to listen to what the entrepreneur has to say? So what must be answered very quickly, and before attempting to move forward in the sales process, or all will be lost and no funding will be forthcoming. In general, an entrepreneur will have 2 to 4 slides and only 5 to 8 minutes max to validate their reason for taking the investor's time, before the investor checks out emotionally and intellectually, if not physically as well. Guy Kawasaki, a well-known venture capitalist, has given some wonderful insights with his 10-20-30 rule of pitching. He suggests that a PowerPoint presentation, or pitch deck as it's commonly called, should have no more than 10 slides, last no longer than 20 minutes, and contain no font smaller than 30 point. These suggestions are not offered willy-nilly. 10 slides can be delivered effectively at a rate of 2 minutes per slide, keeping the momentum rolling forward. The adult human attention span, according to science, rests at about 20 minutes, so running longer introduces additional risk for investor disengagement. The 30-point font emphasizes the fact that the presenter is utilizing the slides as reinforcers for spoken messages, not as a teleprompter from which to read. A pitch delivered using this format within a 60-minute window will allow for a maximum amount of time to conduct Q&A without rushing. When it comes to the structure and flow of your pitch deck, Guy Kawasaki has again provided his recipe for success. There are oodles of opinions as to what an investor wants to see and in what order. Some will prefer Kawasaki's format. Others may prefer front-loading the pitch deck with slides for an introduction, target market with market size and potential, the key problem being solved, and the entrepreneur's solution. Other investors may not have a particular stated preference, but they acknowledge the entrepreneur had better get their attention and quickly speak to why the investor should care and what's in it for them if they move forward with an offer. The pitch is storytelling with a specific business application to solicit a favorable response from the investor that results in a venture funding deal. Though we've talked about the need to address the emotional brain of the investor, the deck's content and supporting documentation is critical as well. The content must answer a number of key questions about the venture, such as why the business is being created, the value proposition for the customer, the demand stimulation and sales plan, why your team is the right team, and why the investor should trust you to deliver on your business model. Financials provided by the entrepreneur are assumed to generally be absurdly optimistic or generally unrealistic, and so spending in excess of time on financials will be a waste. Be sure to detail how the money requested will be spent and how funding to date has been managed to date by providing a statement of cash flows. Finally, don't forget to share what makes you, the entrepreneur, remarkable by telling the competitive edge that you bring to the table. Because it's the entrepreneur that is the #1 deliverable in any venture deal. The bottom line here is that if you want to get the attention of investors and entice them to show you the money, be sure to tell a great story. So now, the moment we've all been waiting for. It's time to close the deal. You've done all the hard work to raise the capital. You just have to walk through a few final steps. The closing process should be relatively easy from here, so don't let an attorney tell you otherwise. If you choose to use an attorney, be sure it's one familiar and experienced with this process. Also, check their pricing to ensure you're not being overcharged. You and the investors have agreed to the terms of the deal, and everything has been clearly documented within the term sheet. The key is to make sure all the documents, or papers it's referred to, associated with the financial transaction is correctly completed and filed appropriately and in a timely manner. Confirm timelines with the investors and keep the channel of communication open. Execute all pertinent documents in a timely fashion, and then ensure that fully executed documents should be returned to the investor for their records. Take a deep breath, celebrate this amazing accomplishment, and then get back to work. Your journey is only just beginning. As we move towards wrapping up this masterclass, we'd like to highlight a few of the takeaways we hope you'll be leaving with today as they relate to our topic of startup funding over time and across the continuum. For well-built and properly structured startups with savvy entrepreneurs at the helm, there is no shortage of capital available. The key is for the entrepreneur to understand what options are available, how much capital is needed to power the startup to the next major milestone, and just what it will take to secure the right type of funding at the right time. Entrepreneurs that understand the funding process, from preparing for funding to pitching and due diligence, through structuring and closing the deal, will find that professional investors will be chomping at the bit to meet them and consider their startup for potential funding in hopes of striking a deal that meets everyone's needs. Learning without application is a form of intellectual collecting. Without applying what you've learned today along the rest of your entrepreneurial journey, you cannot expect dramatic positive improvements. As a means of helping you apply all that we've covered in this masterclass, we have assembled several reflection questions upon which we suggest you marinate as you connect dots and consider how best to apply your learnings to your new or early-stage venture. Number 1. What does corporate structure have to do with funding? And is my venture structured properly to be in position to receive outside funding from professional investors? Number 2. What are my venture's major milestones? And how much capital will I need to get to the next one? Number 3. What are the various types of crowdfunding? And how might this funding option apply to my venture? Number 4. What is due diligence? And how do I prepare for it in order to enhance my chances of receiving external funding? And number 5. What are some of the things an investor is looking and listening for in my pitch? And how may I craft my pitch to improve my chances with the right investor? If today's content has piqued your interest and you would like to continue to dig into these topics for your own ongoing development, we recommend several resources for your extended learning pleasure. Our resource list includes websites, podcasts, and books relevant to the topics covered today. You may find links to each resource on the 3 Steps to Startup website. Enjoy! Well, we have reached the end of this masterclass, brought to you by Tech Connect West Virginia, Innova Commercialization Group, and the West Virginia Jobs Investment Trust. It's our hope that you learned something today that challenged you to think differently, and which provided the insights you need to take your venture to the next level. To check out additional masterclasses and other valuable resources, or to learn more about the 3 Steps to Startup initiative, please visit 3stepstostartup.com. Thank you for joining us, and we will look forward to being with you for the next 3 Steps to Startup Masterclass.